So, good morning, everyone. Thanks for being here today. Do appreciate it. Saturday morning. I know everyone's probably got better things to be doing, but let's talk about what I wanted to do today. Is I wanted to do a follow up of the put options. I get a lot of questions after a class like that, and I want to take a little bit of time to cover some of those things. Again, just to make sure and reinforce them, and then talk a little bit about the trade planning. Now, before we jump in, this is the only slide you guys are going to see today. Before we jump in, let's take a look at the overall markets, what happened yesterday. Now, obviously, I wasn't around yesterday, but I was kind of keeping an eye on things. And you guys, if you take a look at this, you can see that there would have been some shorting opportunities here in this chart. And let me show you that. We got that gap down. Got that gap down right here. There's our gap down in the morning. And you can see right in here, it was a pretty sure bet that sellers were going to support this gap. So there's your shorting opportunity in the diamonds. And obviously a substantial run down throughout the day. And, even if you only took this first move down, that would have been a really profitable trade on the day. And clearly there's some issues here in the market now that we need to pay attention to. First thing I'm going to do is let's take a look at a weekly chart. And you can see here on the diamonds, we certainly at this point have the potential of moving right on down into here. Okay. So we may not be done here in the market. We may have more downside to go. I know no one wants to hear that, but if we don't catch support right in here, if we don't lift off of this area, then we could easily see that quick sell-off down into here. So let's keep an eye on that and watch that closely. Back here on the daily, you can see that pretty clearly as well. If we pull this back, there is a very solid level of support right across here. It's the same place we marked out on the weekly. And you can see if we fail through this support level, we have these levels in here to be thinking about on the daily. So kind of keep that in mind as you're thinking about your week forward. Just a second here. Thinkorswim must have had a upgrade or something this weekend, so that came live. So it took a second for it to do its download. Now, so as you can see here, if we look at more of an intraday, we definitely have that hourly potential support right in here. We've tested this before. So it is entirely possible on that shorter term, we could see a little lift off of this area. And if you go back this direction, there's more price support evidence right in there. So it is entirely possible we could lift off of there. We'll have to watch that price action pretty closely. But obviously a 500-point move in the market is not what anyone wanted to see to the downside unless you were already short, and probably has a lot of folks concerned about the long-term future of the market. Let's take a look at the SPY. SPY. I think there's a high probability, very high probability, that the SPY is going to come down here and test this level. You can see it here on the daily. Even a little bit lower wouldn't be out of the question if we came down into here to test those lows, those little ticks that move down. So watch that closely. We've clearly failed through support, and that's not looking at all good here. If we once again take a look at that weekly, you can see that pretty clearly where that level of support is, and it really wouldn't be a big surprise to see us move down there. On an hourly basis, we do have a little bit of price support right here, as you can see. So that price support, we have to watch this closely on Monday. We could actually get a little bit of a bounce or a lift off of there. So we'll want to keep an eye on it. And of course, remember, we are absolutely news driven right now. Everything is political news that's moving us around. And so we're going to have to kind of be prepared for those big whipsaws, those big moves throughout the day that could completely reverse the market or reverse it overnight. Okay, let's take a peek at the Qs here real quick. Qs on a daily basis, you can see a very high probability of a test down into this area. Hopefully this holds. If the Qs were to fail, you can see there's another level down here, and that'll be a little bit clearer on the weekly chart. Right there is that major support level. So a test down into here wouldn't be all that far out of the question, which is a significant move lower yet still. Looking at this weekly chart, there's certainly nothing there in that weekly chart that would suggest we're quite ready to bottom out yet. It looks like it on the daily that there's an opportunity there, but doggone, that weekly just doesn't show that very well. And let's take a look at that hourly here on the Qs. And once again, you can see there is some price support right in this area. So we don't want to rule out the potential of a bounce come Monday, particularly if some of the news changes. Okay, and if you guys remember, I was suggesting that my biggest concern in the markets the other day was right here on that failure here at that resistance point, and that has certainly proved itself to be true now. And then IWM, real quickly on IWM, we talked about how IWM failure pattern was just about a perfect failure pattern, rallying up to here, shooting star, follow through, evening star pattern developed, and then right on down. And I did suggest that this area down in here could likely be tested. So looking at that on the weekly, you can see how important that level is right there. So anywhere between the top of this range and the lower part of this range. And the reason I say the lower part of that range is because a lot of times we'll run down, we'll hit that support area, and then they'll drive it on through to sweep out all the stops. And then we catch the support. And buyers step in. So we're going to have to keep a pretty close eye on the market. It's kind of a bummer to see it doing this unless you're already short. But, you know, there it is. And we'll have to kind of keep that in mind. So with the short side of the market in mind, it's a perfect opportunity to be talking about put options. And I want to use, you know, just some real simple planning here to determine a short trade. Now, someone the other day, I think it was Thomas, that brought up UAL as a possible short. Anyone that got short of that was probably a little bit worried yesterday as this thing rallied right back up. And I want you to notice all it did was come back up here and test resistance. It didn't quite come all the way through where your stop loss should have been. As a matter of fact, if you look at this on this chart, your stop loss should still be up here. Okay. Or even if you tighten it up really tight, just above that resistance right there. Okay. So let's talk about that for a second. Is there anyone here unclear on how to plan a put trade? What to put together to how we want to look at that trade to maybe enter those positions? And I think this is a perfect example because in this volatile market, you know, we don't have smooth, consistent price action. Lots of whipping, right? So this is one of those perfect examples that you want to put together when you're planning a potential trade in a market like this. We have to expect that ugly whip in the trade. And what that means is we have to stay very, very disciplined to our rules. If we don't stay disciplined to our rules, if we trade a chart like this emotionally, what happens to us? This stock starts to rally up, we stop ourselves out of the trade. and we end up putting ourselves into a losing position that could very easily still turn into a winning position. Would you guys agree? This is the hardest thing to deal with right now, is that whip, that back and forth whip in a trade. Okay? And every trade we take right now, whether it be long or short, has higher risk. It has higher risk because of the volatility of the market, and because the volatility of the market is high, you're going to find that a lot of these trading patterns are going to have that volatility stop quite a ways away from your potential entry. Okay? And if you're not planning those trades, if you're forcing those trades, you're going to end up in a very, very bad situation really, really quick with a lot of stop outs, big losses because the volatility gets you. Okay, does that make sense, guys? So when we plan a trade like this, if we can find this pattern as this is developing, or as it's just developed, and what I mean by that, maybe we had an alert right in here, or you run a scan and you find this trade breaking down. Okay, I'm going to make this a little bit wider. And let's change the color so we can see it a little bit better. So let's say that is our entry, what we were looking for in a trade. And we look at the volatility stop and we place our stop loss up here. Now, once again, if you're studying the price action of the chart, let me change that to a different color. If we're studying the price action of the chart, would I fault you at putting, particularly with the volatility of the market, fault you with putting a stop loss right in here, right above all of that resistance? The answer to that is no. Okay? I wouldn't. But please keep in mind that the volatility of this market, if you tighten up a stop like that, you run the risk of being stopped out at a loss. Okay? Because of the whip, the reversals in this market, you could end up putting yourself in a situation where you're going to stop yourself out before the trade has an opportunity to make you money. So anyone short this would have just been in, well, you wouldn't have been very comfortable yesterday when this had rallied all the way up to here. You certainly wouldn't be comfortable in that trade. All right. But if you'd placed your stop correctly here or up here and really stuck to your plan, you can see this trade still has an opportunity to pay you. Okay, so when we're planning these trades, wherever you decide to do this, you have to look at the risk reward of the position. So let's assume that you started here. You wanted to use this level. I don't care if you use this level or this level. Obviously, there's more risk if you use this level right here. But there would be nothing wrong with planning that trade like that as long as you believe there's enough potential reward in the position. Okay. Had a great time, Fred. Thank you. So right in here, if we had enough reward in the position, we know what our risk is. We can measure our risk with TC2000 real easily. We just drop our line right in here and measure to where our stop loss is, and we could see we would have about 3.9% risk in that trade. Now, if we look quickly from here as well and go down to where the possible next support is, down in here, we have a 6.1% potential profit in the trade. So now the question becomes, is there enough potential profit in that trade for you to put that position together? Okay. If you like that position, if you're comfortable or confident in the downside of the market, would that be a good trade for you? I can tell you, for me, it's borderline. Okay. I would rather see more return in this trade and I would rather see a less risk in the position. Okay. Francis, that's correct. But remember, what's the rule of the trade? We want to make sure that we have the potential in the trade of making double what we have for risk. Okay? So, like I said, this one is borderline just on the stock itself. Okay? Now, if you want to start working this out on a trade basis, well, let's go in and use the theoretical price model and figure out what the actual risk is on the trade. So if we look right in here, darn it, that's somewhere around, I'm going to call it 90.85. Okay? 90.85, right in here on this range, okay? So that's about where we would have our stop, 90.85. So let's go in and see if there's even an option that makes sense. Okay. First, we know, now it would be okay if you planned a January because you're looking for that really quick trade down. But you know, I'm probably going to err to the side of the longer term trade. But let's take a look at the January and let's assume you just wanted to take that really quick trade down. Remember the rules of the trade. We're going to be looking for an option that has deltas somewhere between 70 and 80. Okay. Now this option right here was 69 deltas. Would I rule out that potential trade? No, I would not. Okay, it's close enough to 70 to be acceptable to me. Okay. It only needs just a little tiny move down and you're in 70 deltas. Okay, we're sufficiently in the money. We've got nice open interest here, and you can see our bid-ask spread, you know, is a little bit wide. That's going to be normal in a volatile market, but we would want to negotiate that entry. Okay. So now we know we've got open interest. We've got a potential target, either this one or this one, for a potential trade. This one doesn't have as much open interest, so I would probably favor this one. Okay. So now let's take a look and let's put the theoretical price model on here. And all we do, I'm just going to change my open interest column here, go down to option theoreticals and Greeks, and then pick on Theo price. Okay. I'm going to open up the tool and I'm going to move this stock up, okay, to where it's at 90.80. Okay. So I'm going to move this up by $3 and then roll that up to 90.80. There we are. So this option right here, if we moved up to 90.80, you can see our trade would be worth about $4.33. Okay. Assuming not too much change, volatility didn't spike or something like that, our option would be worth about $4.33. So you have to decide if you get in, let's say you get in at 620, 625, is that going to be an acceptable risk? Is $2 risk acceptable? Okay. So we know our risk in this trade is going to be around $2. Okay. So what's our potential reward? Well, if we take and move our potential profit target down to here, all right, and we measure this down into here, and I'm just going to call it 81.90. You might want to go like 81.75 because you guys know I like to take the trade off before it actually reaches support or before it reaches resistance. I want to front run that trade. When it starts moving close to that resistance or support level, I want to take the profits then. Okay, so let's use that 81.75, or let's use 81.50. 81.50. Excuse me, you are correct. Thank you. 82. Let's use 82.50. Okay, that's putting this up here, right? So we're putting this, we're front running this trade so that we can take profits before it reaches that level. Okay, so I'm going to use 82.50, and I'm going to come back over here to my theoretical price model. We're just going to reset this, and that means we need the stock to move down, right? Substantially. So I'm going to go ahead and move this stock down. Let's move it down by $5, and then we'll have to roll it out here just a little bit. But we're going to roll this down to 50. Okay. So if we roll that down to 82.50, we can see that this option that we're hopefully paying about 6.20, 6.25 on that trade could be as much as $10 in value. Okay, so I'll ask you this question. When you plan a trade like this, are you willing to risk $2 on this trade to potentially make 10? Does that make sense to you guys? That's right. Your potential profit is 4. That's correct. Because our cost of the trade would be about 6.25. And so our potential profit is 4. But what I'm looking at here is I'm looking at the risk reward. Can we risk $2? Okay. For the potential of 10. Now, of course, we do have to subtract our entry cost if we got in at 6.25. And by the way, this was $6.38. So what do we make on the trade? We make $4. Okay. Does that make sense? No, if we use the volatility stop, this trade wouldn't work out quite as well, would it? What we used here is this price support, or price resistance, I should say. We're using that price resistance. And I said right at the beginning, doesn't matter to me, I'm not going to chastise you or anybody if you send me a trade like this, because you're using a level that makes sense in here with the volatility of the market that might work better for you. But once again, I want to repeat, when you tighten up a stop like that, you run the risk in a whippy market of getting stopped out. Okay, the volatility stop is telling us where the risk in this trade really is, but I can understand how you might plan that trade that way. Okay. That's right. We're not. When I put those numbers up there, we planned the trade from where we were entering at about 6.25, right? If we're entering at about 6.25, that means we were going to lose. If this rallied up here, we were going to lose $2 a share. Okay. With the same 6.25 entry, If it came down here to our target, we were going to make $10 a share. Okay? So I'm not pulling some of these posts. I get the idea that you think I'm trying to pull the wool over your eyes and make a trade here that's different than what it really is. No, look at the trade. It costs us this to get in. This would be our loss. This would be our potential gain. Obviously, we have to subtract our cost of getting in to our gain for our actual profit. Does that make sense? Okay, so that's how I'm going to look at this trade and plan this position to see if it makes sense to me. Will that trade work? Now, some of you will look at that and say, there's just not enough potential reward in that trade for me to take that risk. Perfect. Some of you will look at that and say, that's exactly the kind of trade I'm looking for. Okay. Now, please keep in mind, guys, that these calculations are not accounting for volatility. When a stock falls, what normally happens to implied volatility? Yeah, implied volatility rises. Francis, I don't know any other way to explain it. If we take $2 risk in the trade and we have the potential for $10 profit, we have to calculate out the cost of entering that trade. You're going to have to do that on any trade. You buy a stock trade, it's the same way. You got to figure out what cost you to get into the trade and the percentage risk and the loss. I don't know any other way to calculate that. It's the same. Well, Francis, that's obvious. We paid 6 1/4. Okay. We paid 6 1/4. Okay. That's obvious. From where we risk, our risk to our stop loss was $2. I mean, I could put the $4 up here, what it was. Okay. But that doesn't make any difference. We know we have to subtract any costs that we put into a trade off the profit. So you have to decide if that trade is a right trade for you. Okay? Somewhere along, you've got to be able to understand that when everyone has to be able to understand, you got to subtract your costs off of your trade. I don't care if it's a stock trade, an option trade, a futures trade, or anything. Your costs come out of your profits, just like any other business. Okay. So that is your possible potential trade. Now, even if we go with Francis, okay? Go with Francis on this and don't even consider, the $10. I don't care how you guys calculate this. We have a $4 potential gain overall, right? And a $2 potential loss. Is that an acceptable trade to you? Okay. That's what you've got to figure out. All right. So if we take these trades like this and we put these trades together and we think about the position, well, in this market, Bob H., you might, yes. In the 2017 market, no, you weren't you weren't, because first off, when a market rallies, we all know this, our stop losses tend to be closer. Well, Al, remember the rule is that we don't want to take any trade that doesn't give us the potential of making double what we risk. So this right here is borderline, right? It's right there. Now we know we could probably make more than that 1033 down to here, and the reason would be because the implied volatility would probably kick that up just a little bit. You know, if you want to get absolutely technical on the trade. But it doesn't really matter. That's how I plan those positions. I know what my risk is. I know what my potential reward is in the trade. And then I determine whether or not that is worth the risk of the position. And I do the same thing for long trades. Exactly the same thing for long trades. And if you guys are still fuzzy on this subject, I can't remember what the exact number it was for something, but let's use this trade planner that I gave everyone. Okay, if you want to use this, go to the short trade planner. Okay, we're going to take the quarter point rule. We're just going to do 0 here, right? Because we're buying this right from the beginning. We put our entry price in on this trade at 6 1/4. Okay. Our resistance price would be our stop, right? So we calculated in our stop, and I can't remember exactly what the number was, but let's call it 420. Okay. And we put in that support price. What was the support price? It was 1033. And figure it out. Okay. Oh, I got these. Sorry. I think that's how it's calculated. Nope, that's the other way. Can't remember how I did the math in this. But you get my point. All you have to do is do the math. Okay? And I don't care whether you create a spreadsheet. I don't care whether you put together, do it just like I showed you there, and just write it out on a sheet of paper. What we need to know is the trade. Is the trade going to fit you? Not me, you. Some of you are going to look at that trade and say, there's no way. I can't risk $2 on a trade. Then that's not your trade. I mean, let's round that up, okay? We're going to have a $625 trade. We're going to lose $200 up here. Okay? We're going to make $1,000 here minus our costs. Okay. Now, if you don't like the January, if you think the January is too short a time frame, then you look at the February, or you look at the March. I think this one only had a March. You could look at the February weeklies. I generally don't, but you could. I will normally go to March. Okay. And see if there's a trade in here that's suitable to you. and plan your position. Okay? And that's the kind of planning I do on all of my trades. You sold the December. Sold the December contracts. That's a very short-term plan trade. If you're going to go short-term like that on the trade, I would highly recommend you look at an intraday chart. Because this trade, if you're selling the Decembers, or excuse me, buying the Decembers, you have tremendous risk in this position because of theta decay. Remember, volatility is high, so our extrinsic value of these options are very high. If you're in the 87 strike, and did I read that right? If you're in the 87 strike, you have very little chance that this trade will ever make you any money. It's possible if it gets a big move and goes quickly that will come into the money and make you some money. But this is absolutely breaking the rules. Oh, Rickster. Now I understand. I understand. What Rickster did is he actually hedged the trade by putting on a debit spread. He bought the 92.50. Okay, so he's following the rules there. He's in a trade that's now 90 deltas. And then he sold this option, putting on a put debit spread. Okay. That's perfect. Oh, I'm sorry. He sold the December. The short-term option bought the Jan contracts. Thank you, Rickster. Yeah, so he put on a calendar spread, or what Bal said, he put on a diagonal. So he's got a calendar spread. And in the 92 Jans, is he following the rules? 92.5. He's right there at that 70 delta. Doing good on the trade. Well done, Rickster. Nice trade. So all Rick did was reduce the risk of the trade by selling another contract against it. Okay, that makes total sense. Well done. Okay. Well, obviously, Al, it's going to make a difference. If we move the stop loss from here to here, have we increased the risk of the trade? Yeah. If we've increased the risk of the trade, we were just barely at $2 and $4 here, right? In profit. So if we change this, is this going to be a 2-for-1 trade? Risking 2 to make 4? Are we going to have a chance of making double what we risk? No. So if you use that up there, this trade doesn't work. For me anyway. And I told you, as it stands with this right here, this is a marginal trade for me. Okay. So when you're planning those trades, make sure you put together a good logical plan. And here's the thing, anytime I talk about planning trades, what do we have to do when we look at this and say, okay, I've got a $200 risk on a single contract trade? What do we have to do to be able to get comfortable with that trade? We have to acknowledge and accept that risk. If you cannot acknowledge and accept that risk, that trade is not for you. Okay. Does that make sense? If you don't take the time to acknowledge that risk, what's going to happen is you're going to get emotional when this trade starts moving against you. If you're not willing to lose $200, don't take that trade. And that goes for any trade. If you plan a trade and you're not willing to lose that money, don't take the trade. It will not work unless you acknowledge that position. Okay, so however you decide that you want to plan those positions out, that's the way we want to go about it. Make sure you understand what that risk is on each and every trade. Okay, so when I talk about planning, that's what I'm talking about. I'm making sure that that trade fits me, so I don't have to get all worked up if it starts going against me like this one would have yesterday. If I'd have entered that trade seeing that bearish pattern and it went against me like it did yesterday, if I don't know what my risk is, if I don't have an acknowledgement that I was willing to risk that money on the trade, I would never take that position. Ellie, I just showed it. Did you just come in? You're going to do it the same way on a put as you will on a call. You use the theoretical price model. If you don't have a tool, a theoretical price model, you need to get one of some kind so that you can calculate out the risk of the trade. Okay, we know where our stop loss is. I think I said, what I said 90, what was it? 90.80 is where I had that stop loss. Okay, 90.80. So we just use a theoretical price model here in Thinkorswim. We were looking at this contract right here. Okay, I'm going to open up the theoretical price model. I'm going to flatten this back out. If the stock were to move up $3, 88.74, I just run this up to that 90.80 that I wanted my stop loss to be at, and it gives me an approximation of what that option would be worth, about $4.33. So if I buy it at 6.25, somewhere between the bid and the ask, I'm risking about $2 in the trade. Why not use the theory? I've never said you couldn't, Kim. I use the theoretical price model a lot. That's how I get a guess of where these prices are going to be, whether or not the risk reward in the trade is worth it. Okay. That's all you got to do. It's pretty simple. honestly. It's a process that you go through, and actually, once you've done it a few times, it's really, really fast. Everybody looks at this as like it's overwhelming, but trust me, you do 10, 15, 20 of these, and you'll be able to do them almost in your sleep. The problem that I find that most traders get in here, they give lip service to the idea of planning a trade. But in reality, laziness kicks in that we all have. That laziness kicks in and we don't follow through. And then we don't know the risk of the trade. We get emotional about the position and it costs us. Would anyone that planned your trade agree to that? Once you started planning your trade, everything seems to settle down. It becomes much more mechanical. You don't have to get all emotional about the trade. You know the risk before you enter the trade. And if you've acknowledged and accepted that risk, all right, what do you got to worry about here? Just manage the position. Manage yourself. Thank you, Kim. But if you only give lip service to this idea and don't follow through, it's not going to work. You're always going to be in an emotional state if you don't know what the risk you're taking is. And then you panic, you make a bad decision, you exit the trade. You know, isn't it almost worse on something like this, emotionally speaking? You entered this short trade on this day, planned this trade, the stock, well, I should say didn't plan this trade. The stock rallies back up. You stop out up here someplace, can't take the pressure. You stop out. By the end of the day, the stock is back down here, and on Monday it's down here. Isn't that almost worse? Because you were right on direction. You were wrong on your emotion. You created the loss, not the trade. Those are the hardest trades on me. Those were the ones that destroyed my confidence years ago because I let my emotion direct my trading to a point that I would never made money. Not only that, it makes you more emotional, right? It turns you into this great big mess. Because we don't follow through and plan the trade and understand the risk of the position. So this was just the perfect example to show you that, because this market is so whippy, everything we do, we have to expect a kickback. So this just looks plain down, and then we get that complete reversal at one point in the day yesterday. Even though the market was sinking, this one was reversing back up. And if you don't have your plan trade and accept that risk, you'll stop yourself out, and you don't know this could just move right on down now. And you were right on direction, wrong on emotion. Cool stuff? Yeah, you certainly could, Alan, if you're planning a multiple contract trade. I just did this as a one contract trade. But yeah, I mean, certainly, couldn't you do the exact same process? Okay, and say my next target is right down here. Right? So we got a 3 contract trade. We sell one here, we sell one here. And then we hope for the big win on down, and we just look for that next level. You know, where's the next level if it doesn't move on through there? Down in here someplace. That's all you got to do is just place your targets and plan to those points. Okay. Why not use the low of the last 2 days as support? You're talking about right there? Okay. Do you see this chart as long or short, Sean? Okay. Then are you going to, if you do that, are you going to plan any trade that has a support level here? If you think this chart is short and you're using that as support, you can't plan this trade. There's too much risk in the trade. In fact, you wouldn't be able to plan any trade because you're trying to micromanage the price action. There's our trend. We've broken price support. We've broken trend. Here was a big level of price support. We not only failed it, we're consolidating under it and showing failure at that level. Now, Sean, my guess is if you're going to use that as price support, you got to go to a very fast intraday chart. If you're going to micromanage it at that level, you're going to have to trade an intraday. That's the only thing you can do there if you're going to be worried about that level of price support. Okay. That's how you put a trade together. That's how I put every trade together. And I've done this for years and years and years. Okay. You can choose not to do this. That's fine. You can do it some other way. I'm not telling you my way is the only way. Okay. I'm telling you that when I do this, it takes the emotion out of the trade. The trade becomes mechanical. I plan my trade. If I like it for a short trade, I plan my trade, make sure it works for me, and put the trade together. And I don't care if 1,000 other people in the room are trading it. If it doesn't fit me, I am not going to trade it. Okay, not going to trade it. Implied vol on the monthly contract you can see is at 36.51. The whole series is 36.51. So the entire January series is showing a 36.51% implied volatility. Now we could easily look at the implied volatility of all of those. If we go over here, and let's see, where's the implied vol? I don't use that very much. Implied vol. It's going to show that option right there at about 30.69. But the entire series is 36% implied volatility. So I normally just go with the series itself and use that average because we know implied vol implied volatility is like, you know, that nervous uncle or something that's all hopped up on, you know, drinking lattes all day long and just jittery and nervous about everything. That's what implied volatility is. And it's going to move. I mean, it'll move around like crazy on you. And by the way, remember, Alan, everything in here when the market is closed is probably not as accurate as it, well, I know it's not as accurate as it would be when the market is open. Okay, because what happens is market makers spread this stuff out, numbers change, they may not be right on the money until the market reopens and stabilizes. Okay. Alrighty, any questions on any of that? The importance of planning the trade, putting the trades together. Going through that process, it's actually very simple. Now you're going to do the same process for any long trades. Okay. So I did see a question pass through on something like J&J. What do you do with a chart like J&J? Pass right on by. Yeah, if you're short the trade, take the profit. Absolutely. Should have taken the profit. Yeah, there's no trade here. If you're looking to enter a trade, don't get involved in that candle. Stop buying baby powder. Yeah, stay away from that, a chart like that. Look at the size of this candle compared to everything else that's happened in J&J. Is this an outlier? We don't know what this will produce. We don't know if this will produce more downside. If they took all of the bearish energy out of it all at once and the stock bounces on Monday, we don't know. There's no trade here. Trying to trade a chart like that would just be kind of like asking for a beating. Now, if you look at a short-term chart, could there have been short trades in there? I can't even find a good entry into the 15-minute on this chart. It just moved too fast. Okay. So news events like that, I just pass right on by. I don't even care unless I'm in the trade. Okay? Unless I'm in the trade, I'm not going to be watching this chart at all. It means nothing to me. It's a waste of my time. Yeah, the only thing you could have done, Alfred, is from the beginning, if you're in this trade, have your stop loss planned and you get stopped out. That's all you can do. It's a news event. That's all you can do. That's why we have planned stops. That's why we don't get emotional about the trade. That's why we put these trades together and utilize those stops so stuff like this doesn't occur to us. Because I can tell you in the past, this was years and years ago, I would be so overconfident that I had done my work on this trade that this was the right position. How many of you have ever done this? This gap's down in the morning. You don't have a stop loss on. Gap's down in the morning. What do? What's the first thing you think about? Well, I can't lose this much money. This is just a crazy event. This will come right back. and then it's down here. What do? You're negotiating with yourself, right? Oh man, I can't lose this. This has got to come back. Can't lose this much money. It's what Rick says all the time. When's a good time to take that $500 loss? Right? Before it becomes $1,000 loss. And if you are not planned in this trade, if you don't know what you're going to do, this will make you emotional and you'll just watch your money disappear. I've done it so many times. I mean, I made the mistake over and over and over. I didn't follow through. I didn't plan the trade. I didn't. And here's the other thing. I didn't know the risk. So all of a sudden, this drops. This is a bigger risk than I was thinking this trade would be. Can't lose that much money. And then you hold through this. You become frozen in the trade. Now, I know I'm not the only one that's ever done that. Freeze up in a trade and just watch that thing continue to go and go and go and go and do nothing about it. And that's why you have a planned stop and you exit that trade. Nice, Bob S. Smart move. Yeah, changes from a trade. You're right. That's how you turn a short-term trade into a long-term investment, right? And the whole time you're on your knees praying, please come back up. Please, please come back up. So, events like that, there's nothing you can do about it. Somebody mentioned Shop. Let's take a quick look at Shop. Shop gap down news. Was there earnings or something on that? It was a news event that moved it sharply lower like that. There's nothing, and here again, there's no trade to be had on here. If you're long Shop, get stopped out, be out of that trade. There's no, just be out. There's no short trade here yet. Look for a better trade. Okay. Yeah, it's a big move. News driven event on something. I don't know what it was, but yeah, Adobe, and they reported well. Still found sellers after they reported well. So it's one of those examples, right? That even if you're, around those earnings events, you never know what's going to happen. Like a stock can report well, the market could sell off like crazy. It could report losses and the stock rally. Okay. If you need proof of that, just look at Tesla. Tesla keeps going up. The company has never made money. Has so much debt, it almost looks impossible that they'll ever pay it off. Doesn't matter. Stock's going up. Almost all of my stops, Bal, are going to be calculated as a conditional order based on the price of the stock. So they'll always be, because I don't know the exact price of the option, they'll always be in there as a conditional market order. As soon as it trips that price, get me out. And I always put those in market order at the mid. The mid price on the stock. Okay. Costco. Ugly. Whew. Holy shnikes. Yeah, good earnings. Yeah. So just obviously huge emotion came in. You can ask Rick about this. Rick was talking about, or I was texting Rick yesterday, and we were talking about the market failing. Um, and Rick made mention that it's just kind of holding right in here. When it opened, it held there for a little while. And I text back to him that there may be a risk off trade type that happens today because no one wants to hold this risk over the weekend, or very few would want to hold the risk over the weekend. And then we really started selling off. And I think that's really what happened here. I don't think it was anything, CNBC always likes to find, they want to blame it on something. They're saying worries on global trade or worries on, global growth, I think is what I saw them say. The fact of the matter is we were going into the weekend and there's so much uncertainty in this market right now. I could just see people closing trades because they don't want to hold for the weekend. Okay. I've already seen predictions out there. Everyone predicting that the market's going to be down for the next 6 months. Come on. We don't know what's going to happen in the next 6 minutes, let alone the next 6 months. Just follow the price action of the chart. Yeah, I did see kind of some record numbers, folks cashing out of their mutual funds, and that was forcing some trading by the big funds. So all we have to do is wait, right? Wait for the trades to set up, just like we always talk about. Don't force trades. Make sure you plan the trades. Don't trade if you don't like the risk. If you can't accept the risk, stand aside. Wait until the market provides you the risk profile that you want to see. Okay? That's what we have to do, right? And please know this, guys, you don't have to trade every day. You don't have to trade every month to be successful as a trader. I know a lot of folks would like to go back and get back the money that they lost this month trying to force trades when they had no business trading. So protect your capital. If the trades don't set up for you with the profile that you want to see, stop trading. Okay. Thomas, before you start making a statement like that, look at the chart. Do you guys think there's a good chance we're going to find some support down in here? So that does mean some more selling on that weekly chart. But does this mean that the sky is falling here? Think about that for a second. Yes, you're going to have panic sellers. You're going to have folks doing that. But has the sky fallen here yet? Yeah, not even close. It's a crummy market. The volatility is extremely high. But you know where the sky falls, right? When we break this level of support and fail it as resistance. That's where things get really bad. That's right, Jonathan. We resolved the trade situation satisfactorily for the market, and the market will rally. It'll rally big. Okay. FOMC tomorrow, this week, this coming week. Okay. High probability that they avoid the interest rate increase this time, like they've said. High probability. They've said there was going to be one in December. I've already seen Fed members saying we can't raise it again. Too much risk in raising it right now. Okay. What message does it send? It means that the Fed is watching the market here. The Fed is paying attention to what's going on here, and raising the rates would damage it more. So they're going to wait. Okay. The thing is, guys, the economy is strong. You saw the jobs numbers, right? The jobs numbers on Thursday. Our economy is strong at this point. Don't get caught up in the whole gloom and doom thing here, guys. Why is this market doing this? Simple fact is we overpriced everything. Right? Look at this run. Markets do not go up forever. The more we go up without a correction, the worse it gets. Okay? When was our last little correction? Down in here. And we went pretty much straight up. Well, what's that going to create? It's going to create an ugly correction. It's standard. It's normal. I've been through a bunch of these. Yes, it certainly could correct more. Once again, I'm going to say this. If they resolve the China trade war, that's going to remove a lot of the market fears. I don't know whether they will or not. If they don't resolve it, the market's going to stay really ugly for a while. Okay. That's what you got to do, Thomas. Follow the price action. Is the price action bullish or bearish on the market right now? It's bearish. Follow the bearish market until it changes. But recognize the price support levels and where we can bounce. Okay? Don't ignore those thinking that the world's coming to the end, it's all gloom and doom, because you'll miss the opportunities when you do that. I know because I've done that. Okay? So stay focused on the price action. Just let the charts work. Plan your trades. Don't try to make the big prediction. Stop trying to make the big prediction. Just follow the price. Yeah, there's a bunch of them out there, Thomas. And that's the thing is when the market starts to fall, they all come out of the woodwork. See, I was right. See, I was right. But they've been talking about it since way back over here. So, hey guys, thank you for being here today. I appreciate you letting me take yesterday to go to my daughter's graduation. Thank you very much. Had a great time. Very proud of her. Winning or getting honors, graduating with honors. Very cool. Thanks, guys. So make sure whatever trade that you plan, long or short, that you go through that planning process. It's going to help you a ton. Okay? It's going to help you a ton. It's going to help you see the market in a different way, and you'll be able to determine whether or not that trade's for you. One thing I will tell you, if you're a new trader, if you're a relatively inexperienced trader, this is a great market to open up that paper trade account and just practice. Okay? If you're inexperienced, you don't have a bunch of money to lose or anything like that, stay out of this market. Protect your capital. Wait for better days. Wait for those good trades to show up. Okay? Because it will come back around. There will be good times again. In fact, the volatility will start to drop off here eventually. In fact, if we could just get into a downtrend, the volatility would drop off. But we've had these really massive whippy spikes that's created all kinds of mess in the market. You know, oh, we're going to resolve trade. Zoom. Oh, we're going to resolve trade. Zoom. So keep that in mind. Oh, by the way, if we take a look at T21, 22, notice where we are here on T21, 22. Can we still go lower? Yes. Can we bounce? Yes. Wouldn't be at all surprised to see a gap down on Monday and a rally back. Isn't that what we've been doing? We gap one direction and then reverse it. Yesterday was the first day we gapped down and stayed with that direction in like a week. All the other days are either gap up and then a run down, or a gap down and a run up. So we're down here in this area. That would suggest we're going to catch a bounce here before too long. Okay. So be watchful of that. All right, guys, have an awesome afternoon. It's supposed to be in the 40s here. It's supposed to be in the 40s. Middle of the winter for Nebraska, that's summertime. You guys have a elementary ed. She's going to be an elementary ed teacher. All right, guys, have a great one. We'll talk to you all very soon, to Monday morning. Take care. Thanks for being here. I do truly appreciate